Hi, welcome to this channel again. I want you to be rich. Today we're gonna introduce investing part 1 on Warren Buffett, a investing superhero that I follow. He is in his 90s now and still attend the annual general meeting of the company Berkshire Hathaway with his best friend Charlie Munger, who's the lawyer and also a manager at Berkshire Hathaway. A lot of the things that we buy, eat, and consume actually is owned by Warren Buffett directly or indirectly through Berkshire Hathaway. And why do we want to talk about him? Because he's the third richest man after Jeff Bezos, Bill Gates. He's worth $117 billion. This man was born 30th of August 1930. He's in his 90s and still very active in talking about investing. So let's dive a little bit into his background. He graduated from Columbia Business School, New York City, and he transferred from Nebraska, and he was originally from Omaha. Shout out to everybody from Omaha. Great city, great state. He followed a professor by the name of Benjamin Graham. Benjamin Graham is a professor who wrote the book Intelligent Investor, and it really cements the fundamental idea of what is intrinsic value and how to invest for the long term. So this is not for short term, this is for long term investing. And for all of us who are working hard for our money and wanting to learn about investing, this is a great way to learn because his investment strategy is very sound and really very good. Let's get in. Warren Buffett, and explaining Warren Buffett in a 10-minute video is very complicated, but what I really like to emphasize is that every successful person has started young. Warren Buffett, I think at the age of 13, started distributing newspaper and started having a pinball machine because he understood the value of cash flow. And after that, he chased down Professor Benjamin Graham because he believed very much if he learns from Benjamin Graham, he's gonna be rich. And then he moved back to Omaha, a very drastic move because no one who wants to do investing stay outside of New York City, Wall Street. But Warren Buffett did that because he thinks there is too much noise from Wall Street. So Warren Buffett has done a lot of things that's radical, but has proven himself with $117 billion today in terms of net worth because he did things differently. So one of the things that I learned from him is to start young, is to really start learning about money and investing young. Once he started his newspaper distribution business, he started investing and started filing for his taxes. So you're never too young to start understanding investing. If you're 20 now watching this, 30 years old now watching this, 40 years old now, the key is to start. The important thing to learn about Warren Buffett that he's different from everything else that you're hearing on Wall Street is that he doesn't believe in economic conditions. He doesn't believe if the economy go up, go down, that affects too much of his investment strategy. What he believes in, and is very closely linked to Benjamin Graham, his professor, is to look at financial statements. So he studied financial statement, he studied how much cash it has, and understand the intrinsic value of a company. What is it? So how much money does a company have? Is it in debt? And that is the first part you want to look at a company. When, for example, if you're buying Razer, everyone every day goes out to buy Razer, and Warren Buffett owns Razer. Razer has a lot of cash reserves. So you want to understand how much cash this company has and is it in debt. That is the first thing he look at, and if whether the economy go up or go down, people will still buy this product. The second most important thing about Warren Buffett investing is that he believes in the everyday product. So he invested in banks that you use every day, Kraft cheese, for example, Heinz ketchup, Coca-Cola. He also owns some shares in Apple right now, even though he didn't start because that's not his circle of competence. He owns a lot of the products like Dairy Queen that people buy. So a lot of the things that he bought are day-to-day products that you use because he believes whether the economy is up or down, people will still use these products. He also owns Razer. So think about what are some of the products that you use every day and has very good financial statement. That is one way to start for long-term investing according to Warren Buffett's strategy. Warren Buffett believes in his interview that he doesn't want to time the market. He doesn't know what is going to happen in 3 to 6 months, but he believes in buying a company when it's at the right price against its intrinsic value. So he said this very importantly. He said, if you have to closely follow a company, you shouldn't buy it. This is when an interviewer asked him if he's worried that Apple is not coming out with new products. Because if you buy a company, as long as it's well attended to and producing the goods that you want and has a good management, that's why you bought it in the first place. You shouldn't have to look at it every day and cheer for it and say, go, hire you. Because a company has up and down. So he doesn't believe in timing the market. So if you're timing the market, is not a long-term strategy that Warren Buffett believes in. He doesn't know what's going to happen in 3 to 6 months, but he cares a lot about the price, but not something that's going to happen in the next 12 months. Because a good business do well over time. And if you look at the S&P 500, it's done very well over time. So don't time the market, but buy at a good price. So actually what he meant is that if the market is going down, which Warren Buffett does a lot of shares buyback because it's at a very good value. If you see a market downturn, like, I don't know, now, or sometimes when there are some bad news and market overreact and the value of the company is still there, but price very low at the stock market because stock market is irrational, then it's time to buy. And if it's a solid company that people, have been doing, like he said that people are still gonna eat cheese, still gonna buy day-to-day product even when times are bad. It's gonna go down a little bit, but it's not gonna totally be destroyed. And that's the kind of business that he's in. He's not a tech guru. He doesn't understand tech a lot, so that's not his circle of competence. He didn't buy Microsoft. He didn't buy Apple at the start. He definitely didn't buy Amazon. So if you are into technology and into sharp rise in stock price, that is not a Warren Buffett strategy. He is into long-term growth, and he has made over 20% on average, which is very good. And he thinks hedge fund is crap, that hedge fund manager actually perform worse over time, which is very controversial. I think Warren Buffett as an investor repeated the same thing over and over again in different ways, so that we can understand him better. And one of the important things that he said was what an individual business will do over time. It's very important to him. He gave the example of a farm. Whether it's well attended to, whether it has a good yield, it is not so important and never on an economic condition. So just because there's an economic downturn, he's not going to sell the farm. And whether there's an economic upturn, he never ever make a decision on buying a company based on the stock market or economic condition. Never say yes due to an economic condition, and only if the price is right against the assets you're buying. So it's very interesting because a lot of us are looking at the stock market every day, but not Warren Buffett. So he looked at the price. Obviously, he forgot to mention that when the stock market is down, the price sometimes is very nice as well. And he did a lot of stock buyback at the lowest point of the stock market. So he's actually pretty good at predicting when the stock market will be at the lowest. So one of the ways to look at it is to see when Warren Buffett is doing a stock buyback and really sit up and look, because he knows the stock market very well and long-term business. And if you don't know anything, then just invest with Warren Buffett. He talked about the example of how apples fall from trees, and it doesn't change over time just because economics is good or bad. Apples still fall from the tree in the same way 10 years from now. What he's saying that human behavior, there are some basic behavior that doesn't change. We still like products that are cheaper, better, faster. There's something that a customer behavior that doesn't change. And so it's important to understand what are some of the products that are evergreen and has a good management. So look at the management, who is managing the business, because that determines how the business is run over time, the culture of the business, and when the price is right, put in an investment for the long term. And that's how Warren Buffett invests over time. He invests in good business. The next video I'm going to talk about is what kind of business he invested in and why he invested in them, so that it helps you understand investing as a general idea if you're starting to invest, or if you have invested and lost money and say, I'm never going to invest again, I'm just going to buy an index fund. So maybe listening to this is going to help you understand how Warren Buffett invests in individual stocks and maybe give you some ideas. Or if you're a mature, advanced investor, understanding how Warren Buffett invests is different from you might also be interest to you. So yeah, thank you for watching. If you like it, please subscribe, and the links below for Benjamin Graham's books and some books that I really love about Warren Buffett that might help you.